the thing I'd love to sort of understand and unpack, because it is often talked about and not always understood, what is private banking? What does it look like?
So private banking, explained very simply, is a team of specialists united around the customer,
Yep.
offering banking requirements, which could be home lending,
Yep.
or even opening day-to-day accounts, doing international transfers, etc., and also investment and wealth advice. So you're looking at a team of specialists around the customer delivering these different services, and which is why NAB Private Bank has got its motto as united around you. So that's our thinking.
Right.
You got a customer, the customer has different requirements. We as a team of specialists are united around you.
Yeah, and that's the biggest thing with property investing, for me at least, was I needed people to help me. And I thought, you know what? I've read all the books. I can do absolutely everything, every single step of the way myself. And I didn't listen to advice, and I didn't do the things that I should have done. I didn't build we call it the A-team. We didn't build our A-team around ourselves. And that kind of hemmed me and ruined potential future opportunities that I have, because I didn't get the right brokering. I didn't get the right, accounting advice. I didn't get the right information about what kind of areas and locations and things like that. I didn't have that A-team around me, and having that is those people that have that, I see rapid accession to their portfolio.
Totally agree. And that's the part where, if I may share, this is a bit of a profile of a private bank client.
Okay, yeah, go on.
Yeah. And also what you need to actually get into, how do you access private bank? That's probably another one.
Yeah.
So it just builds a segue into it. So private bank is by invite. So I cannot walk into a branch and say, hey, I want to join private banking. Doesn't work like that. So there are certain criteria of entry into private bank.
How do they give you that? Like, is it like a letter? Is it like an owl dropping a letter?
Do I get a key?
Is there a key? How do you get the invitation? Like, what should I expect to come to be?
So usually you would be somebody who has got a plan in place, very ambitious, and have got the criteria to entry, which is $400,000 household income per year.
Okay.
So household income,
Yep.
husband, wife, partner, however. And you should start off with at least 2.5 to 3 million worth of loans. That's the starting point.
Okay.
We would say 3 million because at 2.5, you're probably too restricted in terms of choices and options. 3 mil kind of starts freeing up because you would have raised your income levels as well by that time. So usually for 400,000, 3 mil kind of starts.
So is it either or? Like, if you're at that 2.5, 3 million net worth, but your household income's 250, do you need to have both criteria met?
It's both criteria. So it's 400,000 household income and 3 mil worth of loans. And there's also another side of it. Some people may not have 3 mil worth of loans.
Yep.
That's because they have gone past their, the journey of accumulating wealth, but they would have investments in other forms which are 3 million and worth, which actually need a private banker.
Yep.
Yeah.
So those are the two angles that we have. That's the criteria for entry.
How does the whole financial transaction for people to get loans and servicing? Like, what is the benefits of having a private banker?
Yeah, probably versus retail. So I'd love to hear where the differences lie, because that'll be
absolutely,
powerful.
yeah. So let me give myself as an example. I fit into the retail space because I'm a PAYG employee, and then I fit into the retail space.
Yep.
In a couple of years' time, if I get more money, if I make more income, then I would move to another space within the bank, which is crucial to understand, if I may touch upon.
Yeah.
So in any banking system, you've got the retail banks, which start off here. That's where I walk in and say, hey, I need a credit card, I need an account open. The branch helps you, it's transactional, you walk out, happy man. Then you've got the next level, which is the business bank. The business bank is where, remember my example where an individual has invested, they've got a business running, they're also building their portfolio of assets.
Yep.
So business banking clients require totally different kind of funding, overdrafts, working capital, foreign exchange. That's where business bank comes in. Above that comes private bank. And Private bank then now starts to look at people who have built that amount of wealth or are aspiring and in the journey of getting there to build that amount of wealth, but can start off because they have met the criteria for entry. Above private bank comes corporate banking. So there's different layers. Now, going back to your question, in terms of private bank, how does it benefit from a lending perspective?
Yeah.
Usually, when you are in retail space, it is very black and white.
Yeah.
It's
Checkbox.
the PayYG.
Yeah.
You show your 2 pay slips, you get a loan based on your borrowing capacity. But
that's just because someone walked off the street, right? They're just walking off the street. Hey, I want to have $1 million worth of debt. So you have to have those, checks and balances in place.
100%.
Otherwise, you're gonna who you gonna give the money to?
Correct. 100%. And that's probably where everybody's starting point is.
Yeah.
Right? And some people then go, okay, I would like to start doing different things. Now, here is where the importance of a bell curve. I'm just going to get you guys to imagine a bell curve, right? Just imagine a bell curve for me. People join private banks in different times. Some people join right at the starting of the curve. That's because, the 18-year-olds or the 21-year-olds who've already got 2 or 3 properties or 4 properties, they've already hit the 400K. They are ready to go.
Yeah.
I've got one client, 26, has got about 12 properties.
Wow.
Already has a plan that by reaching 30, I need X million net wealth. So he started private banking at the start of the curve. Then as you grow your wealth, you're probably reaching the middle of the bell curve where you have a sufficient portfolio.
Yeah.
And now you're thinking about, I want to diversify more. I want to step out of property, have a passive income stream, which is what most people would start doing when they hit a certain level, because they want that passive income stream to feed off their lifestyle.
And then
holidays.
How are those people setting that number? Like, how are you, because you deal with very sophisticated investors, how do they think about that number? How do they feel about that number? Like, how do they set that number?
So that point is when a trigger event happens in their lifetime. They would have gone and sold a property, or they would have had a sale of business, something which triggers where there's a huge pot of money coming in, or a decent size of money coming in, where they want to actually say, okay, I'm still going on my residential or property investment journey, but I've got some spare, which I don't want to put into a term deposit. I want to actually start thinking about investing where I can get better bang for my buck. There's a trigger event usually, Joe. That's when, so no one's going to go and say, if I hit this, then I'm going to start diversifying. Rarely do they do that. An event happens when it triggers to them, usually from their private banker saying, what is your next step? And remember the timeline I had spoken about. There's a timeline for all these people. They'll be like, okay, when I hit this, I start doing plan B, which is passive income stream.
Yeah.
And then you come down the curve, you've got the people who've got all the wealth. Now, equally important is as much as you make wealth, you have to preserve the wealth as well. Currently in Australia, you have probably about 55%, I think. Just randomly calling off from what I read, it is baby boomers, right?
Right.
Now, that is gradually going to shift. It's only 14% or so, which are the very young generation. I don't know what they're called now. There's a lot of millennials, Gen Z, all that kind. So whatever they're called now, that is what 14%. That 14% is going to grow. And within that 14%, within your subscriber group, there would be individuals who are going to inherit money from parents, grandparents, or from some other source. That is a classic case where they have to start thinking of now as to how do I build a timeline in terms of using this money, enhancing it, then preserving it. And then that's where private banking again kind of helps people.
Yeah.
Most people actually, maybe because of ignorance, they just go hunting for rates and then they just keep jumping from bank to bank or from institution to institution. And they're enjoying the short-term benefits too, which is great. But you will reach a certain point of time when your income is not probably going in parallel with your aspirations in your property portfolio aspirations. So you will kind of plateau. At that point, if you have a relationship with an existing bank, then it works wonders. The banks can actually see what kind of a customer you've been. Has there been any default even in the past? The banker would know the customer because I've been looking after the customer for 3-4 years or 5 years. I can vouch for this customer. What does a sophisticated investor think like? I would say they're not scared to go and look for good debt. That's the term I'm introducing, good debt.
Okay.
So, again, this is personal. You could have a particular expense as a good debt, or, I could probably think, no, not really. I mean, looking at Joe, I think he would love to have a Ferrari, and if he goes and gets a loan for it, it's good debt for Joe.
It's great,
probably.
great debt.
Yeah, for me, no. It's I'm just in a lighter way, and I was just putting it across. So different people have different perceptions about good debt. But with most sophisticated investors, they have a very clear risk plan or a risk strategy. I am going to borrow X amount of money at Y rates for a certain period of time at which an event is going to happen, or I am thinking of doing this particular event, maybe a sale of an asset or disposing another property which has kind of plateaued and hit its mark. There's nothing more in it, where I'm going to get some cash flow. Would have already worked out the CGT implications in advance with the accountant. What happens if I dispose off? So that calculated risk plan is in play. That's pretty much how most sophisticated investors think. Hence, they've got a clear timeline. They know what they're going to do, subject to everything being normal.
So do they come to you with like a deal? So like a 1 into 5 development. They're going to say, hey, I need to get this 1 into 5 development. It's going to give me 15% return over the next 2 years, and I need to get this money. Is that kind of what they come to you? And then in 2 years' time, we're going to sell off and do all of that?
Yeah, so good point that you made. So if they come to us, they would come with a business plan. This is what I'm thinking. This is what I would like to do. What is the bank's appetite? Which is when the banker would go in and do what is, we always, if we feel that this is a bit of a tricky one, or if this is complex, or if we feel that there is an element of ambiguity here, because every financial institution has got its own policies. And to deviate from the policy, you need consent, or you need the support from our risk or credit stakeholders.
An exception.
So before going and committing to the customer, a good banker should definitely go and check with their credit stakeholders. This is what I propose. Any concerns? And then they would come back with concerns if there are any. You go back to the customer, you have that interaction, and then you hit a midpoint where every party is happy. So that's going back to your question. Do they come saying, I want a certain thing? Yes, with a business plan. Then we run through the business plan. We have discussions with our credit stakeholders if we feel it is necessary.
What are mistakes people are making as well? I know is it the opposite of what people are doing well, or what?
The biggest mistake is going and committing into something without knowing what your borrowing capacity is. That's what I would say.
Right. Just going into a deal.
Just getting, really attached to a property because you just love it for whatever reason, or someone's actually sold you that property and you've just gone and said, yes, you signed it, and then you realize, okay, I'm stuck. But then there's always an exit plan. They would probably have another property where you can sell, and then you can make up, or you can bridge different scenarios. But that is probably the biggest mistake, without having an open conversation with your broker or your banker and understanding where you stand in terms of borrowing capacity, especially in this current environment. It's probably the biggest mistake that people are doing. Otherwise, Australians are very switched on with property investment, mate.